Welcome to the midweek edition of Daba Markets Talk, where we break down the stories shaping African markets and explain what they mean for investors. Today, we are examining one of West Africa's longest-running economic ambitions, the plan to create a single regional currency known as the ECO. For more than 4 decades, leaders across the economic community of West African states, or ECOWAS, have discussed replacing the region's multiple currencies with one shared currency. The latest target is 2027. That promise has been made before. Deadlines have slipped, political disagreements have emerged, and countries have repeatedly failed to meet the economic conditions required for monetary union. But ECOWAS now says it has a more practical plan. Launch first with the countries that qualify and allow others to join later. So, is the ECO finally becoming realistic? Or is 2027 simply another date in a long history of postponements? Picture a trader in Lomé selling goods in Lagos. She starts with CFA francs, converts them into Nigerian naira, and may use Ghanaian cedis to pay suppliers in Accra. Every conversion creates a cost. Every currency movement can reduce her margin. That experience is repeated by traders, manufacturers, students, migrant workers, and families across the region. A single currency could lower conversion fees, simplify payments, make prices easier to compare, and reduce exchange rate risk. That is the economic prize behind the ECO. The idea dates back to 1983, when ECOWAS leaders commissioned studies on a unified monetary zone. It was later written into the revised ECOWAS Treaty, which called for a regional central bank and a single currency. West Africa, however, is already divided between different monetary systems. 8 countries use the CFA franc through the West African Economic and Monetary Union, or WAEMU. They share the BCEAO as their central bank and operate under a currency pegged to the euro. Nigeria, Ghana, Liberia, Sierra Leone, Guinea, and the Gambia use national currencies. In 2000, they created the West African Monetary Zone, or WAMZ, intending to launch a separate currency before merging it with the CFA franc zone. That launch was scheduled for 2003, then 2005, 2010, and 2015. None of those deadlines survived. In 2019, ECOWAS agreed on the name ECO and targeted a 2020 launch. But a dispute emerged after Côte d'Ivoire announced plans to reform and rename the CFA franc as the ECO while retaining its euro peg. Nigeria and other WAMZ members objected. They wanted a new ECOWAS-wide currency, not a renamed CFA franc. Then came the pandemic, wider fiscal deficits, higher inflation, and another postponement to 2027. The central challenge is not designing banknotes. It is economic convergence. A currency union works best when participating economies behave in broadly similar ways. If one country is booming while another is in recession, a single interest rate may not suit both. ECOWAS therefore developed 4 main tests. Inflation should remain in single digits. The budget deficit should not exceed 4% of gross domestic product. Government borrowing from the central bank must remain limited. And countries should hold foreign exchange reserves covering at least 3 months of imports. These standards are meant to protect the shared currency from weak fiscal discipline in any one member state. But performance has been poor. According to the Daba Pro report, only Ghana had ever met all 4 primary criteria in a single year, and only once. There is also the problem of asymmetric shocks. A fall in oil prices may weaken Nigeria, an oil exporter, while benefiting an importing country through lower energy costs. A drought may severely affect an agriculture-dependent economy, while having less impact on a services-led market. With separate currencies, countries can change interest rates or allow their currencies to depreciate. Inside a monetary union, one regional central bank must set one main policy rate for every member. That becomes especially sensitive because Nigeria is far larger than every other ECOWAS economy. Its oil exposure, inflation history, and floating exchange rate differ sharply from the more stable euro-linked CFA franc economies. A West African central bank would therefore face a difficult question. How should it balance Nigeria's scale against the needs of smaller member states? Joining the ECO would also mean giving up independent control over interest rates and exchange rate policy. That increases the need for coordinated budgets, strict fiscal rules, and a regional stabilization mechanism for countries facing local crises. So, what may be different this time? First, ECOWAS is now smaller. Burkina Faso, Mali, and Niger formally left the bloc in January 2025. Their departure weakens regional unity, but it may simplify some coordination challenges. Second, the launch is expected to be phased. Instead of waiting for every member to qualify at once, the ECO could begin with a smaller group that already meets the criteria. Others would join later. That is more realistic than an all-or-nothing launch. Third, there is more visible institutional preparation. ECOWAS has registered the ECO trademark with the African Intellectual Property Organization. A presidential task force is working on the future central bank and whether CFA franc countries join immediately or later. Fourth, the regional backdrop may be improving. ECOWAS leaders have pointed to easing inflation, lower debt ratios, and stronger current account positions in parts of the region. Although government deficits remain a concern, if successfully implemented, the ECO could reshape trade and investment. Businesses could invoice customers and pay suppliers in one currency. Cross-border transactions could become faster and more predictable. Regional companies could build supply chains across several countries without constantly managing exchange rate exposure. For investors, a credible ECO could create a larger financial market. Governments and companies may gain access to a broader pool of savings. Common standards could make bonds and equities easier to compare, while deeper regional markets could attract international capital. The ECO could also support the African Continental Free Trade Area. AFCFTA aims to reduce tariffs and connect African markets. But tariffs are only one part of the cost of trade. Currency conversions, payment delays, weak settlement systems, and exchange rate volatility can still discourage commerce. A shared currency could complement the Pan-African payment and settlement system by reducing the number of currencies involved in West African transactions. Still, the ECO would not solve everything. The region also needs better roads, ports, electricity, customs systems, security, and predictable trade rules. A common currency cannot compensate for weak infrastructure or inconsistent policy, and a rushed launch could create more instability than integration. The real test is not whether ECOWAS can print eco banknotes in 2027. It is whether governments can maintain the discipline required to protect the currency after launch. Can member states control inflation? Can they limit deficits? Can they trust an independent regional central bank? And can they accept policies that may not always suit domestic political priorities? For now, the 2027 plan looks more structured than previous attempts. A phased entry, an active task force, and legal preparation suggest that ECOWAS is doing more than repeating an old promise. But after more than 40 years of delays, investors and businesses will judge the project by implementation, not announcements. The ECO remains a powerful idea. Fewer barriers to trade, simpler payments, and a more connected regional financial market. Whether West Africa can finally turn that idea into a credible monetary union will be one of the continent's most important economic stories heading into 2027. That's all for today's midweek edition of Daba Markets Talk. For more insights on African markets, investing, and the forces shaping the continent's economy, follow Daba Finance and subscribe wherever you listen to podcasts. Thanks for listening, and we'll see you in the next episode.